All right, Ken Orange Theory Trader going over the best stop loss levels. Let's go. So the stop loss answers one main question. Where do I expect price not to go if I'm right? Or as a statement, if I'm right about the direction, price should not go here, wherever your stop loss is. So you have choices actually. And I didn't go through these earlier. So you can do a lower time frame stop loss if you trade lower time frames. You do an ATR based stop loss, high day, lower day, daily open, weekly open, prior day high, prior day low, or candle one high or low, or candle two high or low on the higher time frame that you're getting your CRT structure from. So let's go over them. So the lower time frame stop loss. Okay, I trade the 1 hour. I used to trade the 5 minute. The benefit for placing your stop loss around those levels are you will get a tighter stop and it could lead to more risk to reward or higher gains. But the drawback, you're going to have more stop losses hit and it could be bad for your psychology. So here's an example. This is a 1 hour chart. So just based on the structure of the 1 hour chart, you could put a stop loss below, let's say, this liquidity sweep and these equal lows here. You're saying, okay, if I'm right about the direction, and this is not about the entry could be anywhere. Your entry could be all the way up here. It doesn't matter. The point is this, is that by the time you take the trade, either anywhere in this consolidation, this candle here, this candle here, I don't, this is about where you want to stop your loss. Okay, literally stated. Okay, if I'm right, you could just see simple strong support right here, to use a common term, and just say, okay, if I'm right about the direction, no matter where I get in, price should not go below these lows right here. And you just do that. Now that's based on the lower time frame. But please believe, I've seen plenty of times where price can open on a day, wick through all of this gap, even wick through this whole gap, and then keep right on going. All right. So that can happen. It will happen. So just be aware of that because you're basing it on a lower time frame. Next up, you have an ATR based stop loss. Now the method is this. It's not hard. You just need to know what the average true range is of the pair you're looking at. And what you do is you place your stop loss based on the multiple of the ATR that you're looking at. For example, if you're looking at a chart and its ATR for an hour is 10, okay, it moves 10 pips in an hour on average, you would just simply place a 20 pip stop loss because that's above the average. You're not expecting it to move 20 pips against you if it typically only moves 10 in an hour. I hope that makes sense. So it takes the guesswork out of placing your stop loss. However, you could see more losses because it's not based on structure. It's just based on a measurement of movement. So for example, this right here is I had to do an entry to show how it would look for this one, but the rest of these will not have entries. So I just did a random entry right here. Now, and it's going to be the same chart for all of these examples. So this entry is right here, and the ATR at the time of this chart was 19 pips. So Euro New Zealand would move 19 pips in 1 hour on average. So you could just place a stop loss 20 pips away from your entry. You would double it. So if it moves 19 pips on an hour, then in 2 hours, you're saying that it shouldn't move against me by 20 pips if it's only moving 19. And that's about 19 pips right here away from this entry on the 1 hour open right there. So stop loss will just go right there. So you can do a mathematical type deal whereby you just based on the average true range, leave it at that, done deal. Okay, so that's that. Next up, you have a higher day, a lower day stop loss. Now the benefit of this is that when you get the true high of day and low of day, that is the strongest that's the strongest resistance and support there is for the whole day. But the only drawback is you may think you have the high of the day and then it gets taken out. So you can still get stopped out even if you think you're nailing that level. But let's take a look at this real quick. So on this day right here, this is the low of the day, and this indicator is the mark levels indicator on TradingView. It'll automatically label these levels for you. Okay, but if you think you have a set low a day, you just put the stop loss 5 to 10 pips below it. That's it. All right. So regardless of where you get in, you're saying, okay, if I'm long and if I'm right, this day's low should hold. So that's it. So you look for it, measure about 5 to 10 pips away. Stop loss goes there automatically. So even if you get in here, up here, up here, it doesn't matter. Stop loss is set. Okay, so that's that. You could do the daily or weekly open price. Now, I like this one because it helps capture momentum. Because remember, if you're trading a candle three, you're expecting a strong, just expansion candle in one direction. So I like to quote the start and stay rule. If price starts to turn green and you're long, that candle should stay green. It should not be flopping back and forth. Okay, if it starts to turn red, it should stay red. And if you're trading a daily candle, the open price is the benchmark that you can use to let you know what color the candle is. Now the cons, though, it can lead to stop outs, and sometimes you get stuck in consolidation where price will just constantly pin the open price of the day or a week. It's annoying, but I've seen it happen to me. But I did both in one for this example here. So I'll do the weekly first. Weekly open as well. Same thing. If you're bullish for the week, once price starts to turn green, it should stay that way. So if price breaks above the weekly open, let's say right here, you place your stop loss 5 to 10 pips. You may want to do more. It's up to you. But you're expecting it once it crosses this weekly open barrier to stay above it. So, could have got an entry there, stop loss goes down here. Same thing for the day. This is the daily open right here. Once the price goes above the daily open, price stop loss can go 5 to 10 pips below the daily open, right? So that's that. Let's keep going. Prior day higher low. This works good for continuation day or candles. I know I say a prior day or low on here, but you can also add like prior candle higher low too. So as well though, these levels can constantly get wicked out because it can do a fast stop out and then continuation. So I know you've seen that happen where you think the prior day low or high may hold, price spikes it real quick, does a liquidity sweep, and then you were right about the direction, but it's just one of those things where price decides to just go down there, get those orders, and then continue on. So this is an example right here. So this is the prior day low right here. Okay, market levels can mark that for you too. So anywhere on this chart you could have got in, but your stop loss again goes below prior day low because if you have a true trending market, the prior day lows should hold when you're long, and the prior day highs ideally should hold if you're short. That's the logic behind that stop loss placement. You also have the candle one higher low. So typically it can offer a tighter stop than candle two, and it can yield a higher risk to reward, but you can have more stop outs because sometimes it can be tighter. So you have to draw your CRT structure for this and just identify the low of candle one when you're long. So right here, if this is the low of candle one, regardless of where you get in, expecting candle three behavior, or four behavior, either way, you're expecting price to stay inside the range. So you just place your stop loss 5 to 10 pips below the low of candle one. This is candle one right here. Okay. So if you're right, price should not go back outside of candle one. All right. So that's that. That's where that stop loss will go. Candle two higher low. The best thing about this stop loss placement is the safest stop loss placement there is, but you're likely to get smaller positions and it can be a very wide stop. Okay, so this is the low of candle two. So, if with your entry all the way up here and your stop loss all the way down here, again, the odds of you getting hit when you're right are slim, but at the same time, every chart's not going to have these monster moves. Okay, so don't get used to that. This is just one example here. Okay, but this is the safest stop loss placement that there is, below the low or above the high of whatever you think candle two could be. So in conclusion, contrary to popular belief, the stop loss placement is more important than the entry. All right. Just remember to have your bias, analysis, and your execution. Form a bias for the candle range theory, be you long or short, analyze it, and then go ahead and get in. Okay. Execute not only the entry, but the stop loss. You should know your stop loss before you take your entry. So figure that out first. Risk management is always going to be number one. You can experiment with this on demo. See which stop loss fits each trading scenario. You can be flexible. The great thing about this, you can walk into a chart at any time and based on your bias, formulate your stop loss before you even take the entry. Remember, if you are right, your stop loss should not get hit. And if you're wrong, just be okay with it. You were wrong. It's fine. Okay. Candle two is the safest. The lower time frame stop loss is the most risky. And once you take the trade, please don't move your stop. What do I mean by that? If you get in thinking that, let's just go, like for instance, let's go here. Okay. If you enter here and do an ATR stop loss at like say 19 pips, don't then say, okay, you know what? Never mind. I'm going to move the stop down here to these equal lows. Don't do that because it's going to throw off your risk to reward ratio, or not risk to reward ratio, but your risk management. I would hope that okay, I'm comfortable losing, let's say 5% of my account when I take this. But now when I see something I don't like, I'll move the stop down here. Well, now you're going to risk, possibly 10, 20, 30, 40, 50% of your account because you're moving the stop. And when you move a stop, all you're doing is increasing your risk. Please don't do that. Okay. This is already worst case scenario. Once you get stopped out, if you want to try to restructure it, fine, but let the trade play out. Okay. Or if you do that, I recommend get out of the trade if it goes against you, and then just take a fresh entry with a fresh stop loss level. Do it like that, but don't move the stop and keep the entry. It's okay to take a small stop out and then just completely restructure the trade instead of I'll just move the stop loss and don't worry about the entry. No. If the criteria breaks down, just nix the trade and start fresh. Then move the stop like that. Don't keep the same entry and move the stop loss. All right. I hope that makes sense to you. Okay. If you have a bad feeling about it, just cut the trade for a small loss and then say, you know what, let me put it below this low right here and do it like that. Okay. So what we'll do as a special bonus, I'll take a look at a live chart to show the power of this. I'll just do one. So let's do, and I hope I got my I got a chart open in another window, but I hope you guys can see this. Let's just pick Aussie CAD. Okay. So let's see here. So you got look for some structure here. Okay, this is super hypothetical because there's really no structure. But let's just say hypothetically, okay, hypothetically. All right, that I'm thinking this is a candle two. And I wanted to be a real risk taker. Okay. I'm not saying, and I don't trade candle two. I would not recommend that. Okay, but let's just say, okay, I think candle two is going to be right here. And then I drop down to a lower time frame, like so. And then I say, okay, this is the low of the week and the low of the day based on what market levels are saying. So I'm going to play, before I even get into the trade, I'm going to place my stop loss below the low of the day by 5 to 10 pips. So I would do it like that. Okay, this is a rushed example. So let me see. Let's say like 10 pips. So stop loss would be like right there at 1.83183. Okay, right there. Okay. So I'm not saying this is going to hold. I'm just saying this is how it would look, right? You just come to the chart at any time, see where price is, see where you think price will not go, place your stop loss there, and be done with it. Or another option too, you just remember your levels and say, okay, if price gets above the daily open, see the daily open price. If price closes above it, I'll set my stop loss 5 to 10 pips below the daily open. That's another option. Or you can also go to, let's get the master list here. Remember I talked about prior day high and prior day low candles, or even the prior candle, higher low. If it's a real trend and price breaks above the daily open, or if this candle close, let's say if this candle closes in 7 minutes and I still think it's long, I can place my stop loss a few pips below this candle's low because I think it's going to hold. Now, is that a guarantee? No, but if I believe in the direction, that would be the same rationale: prior day or prior candle, higher low. So I hope that makes sense to you. So again, pick the one that makes the most sense to you. Again, that's the master list right there. Make a note of it. But I appreciate your time and attention. Thanks for watching and have a great rest of your day. Take care.